But the funny thing is the Federal Reserve has about $1 trillion worth of unrealized losses while operating at a loss. So it's actually in if it were a bank, it would be bankrupt. But because of just its own operating thing, it's still able to operate, and it just kind of shows the crazy times that we're in.
Our next guest is saying that the Federal Reserve on paper has officially gone broke. Stock markets won't see the types of high returns we've been used to over the last decade, and we're headed for an economic downturn. But how severe is this downturn? Lyn Alden has the answers. She is the founder of Lyn Alden Investment Strategy. Lyn, an absolute pleasure to host you again. Welcome to my new show.
Happy to be here, and congrats on your new show.
Thank you. Very pleased to have you on the show. You are one of the best macro thinkers that I know, so I'm sure the audience will find you find your message worthwhile. I want to talk about data that came out today first, and then we'll lead into your broader macro outlook. So initial jobless claims came in today, seasonally adjusted 228,000 for the week ending on April 1st, but economists have predicted or expected 200,000 claims this week, so this number was higher than expected. What's your read on this number? Is it an indication of a healthy economy or not?
Well, it shows some degree of deterioration. And I think if you zoom out and look at the continuing claims, that gives a clearer sign of labor market deceleration. That's been a more steady march upward since late last year. And when you look at economic indicators as a whole, right, you can watch them in rate of change terms, right? Rather, before they go negative, they start decelerating at a positive rate. So they've been accelerating, then they start slowing down while they're still growing. And some of them tend to be more leading than others. And so you see things like manufacturing activity start to slow down early. You see, other signs of liquidity start to slow down early. And the labor market tends to be one of the later signals. It's kind of lagging or coincident with recession by the time that really rolls over. And so that has been one of the more resilient areas in the economy over the past year, really, as you've seen a lot of other things decelerating since late 2021, and labor's held up, which is not unusual for that to be kind of on a big lag. What made this cycle somewhat unusual, though, is that a lot of times you see labor weakness in some of the lower income type of jobs. Whereas in this environment, because certain sectors are so interest rate sensitive and interest rates have really been what's driving this kind of deceleration, you've seen the layoffs more in tech, more in real estate, finance, kind of these types of areas where, if anything, some of the lower income jobs are still facing shortages, still facing outright shortages in some cases, and I think the wages are going up rightfully. And so you see kind of like a bifurcated market, almost two different types of economies out there. But I think that we are kind of increasing evidence towards recession, and some of these recent labor market prints are kind of pointing that way now.
Okay. What's interesting to me is, again, like you brought up, it wasn't just the tech sector that's starting to see layoffs. Recently, just over the weekend, McDonald's is announcing more layoffs, which is surprising to me because you think like a consumer staple stock like McDonald's would be more resilient during the recession. But is this just a micro problem of a company problem, or is this a problem of a larger systemic issue that all industries are about to see more layoffs?
I don't know about all industries, but I do think it is broader. I think, you can only have so many one-offs until it's clearly a trend. We've seen that in tech. We've seen that in parts of finance. It is interesting that it's starting to hit some of these less interest rate sensitive areas. In some cases, they did, just accumulate extra labor compared to what they needed, especially, when labor is scarce, you kind of hire first and figure it out later. So I think there's some of that normalization, and some countries, some companies will be more affected than others. But I do think we're starting to see kind of a broader deceleration. And like I said, it won't necessarily impact every industry, and it certainly won't impact them all equally. But I do think it is the things tend to spread because, for example, those laid off tech people, they will travel less. They'll go out to restaurants less. There may be not directly impacting something like McDonald's. That's a broader story. But basically, when you see people lay off one sector, even if other sectors are not the epicenter of it, even if they're not being hit as hard, they're still impacted by other people losing their jobs.
Just more of an out of left field thought. Perhaps and feel free to challenge me, but perhaps a rise in an uptick in layoffs, maybe due to the fact that employers are embracing automation on a wider scale. Just going back to McDonald's, for example, I was reading that they were experimenting with fully automated restaurants. Nobody in the store at all. I don't know if that's going to be implemented anytime soon. They are experimenting with that. Perhaps they're positioning themselves for more automation, more AI to take place in the workplace, and perhaps that is a larger trend. What do you think?
So I think that certainly labor pressures, higher wages, incentivize more automation. I think that's been really clear in the grocery store market, where you see fewer and fewer, human cashiers and more of those automated checkout areas. We're seeing that, hit fast food restaurants more as well. That's not a surprise. The McDonald's case, I mean, they still need people in the back, until robotics gets advanced enough that you don't even need, people cooking. But certainly ordering and things like that can trim certain types of labor and make that more efficient. So I do think that automation and AI is, it's already been a multi-decade trend. I mean, you can go back to the 2000s and the 1990s, and automation was already there in certain sectors. As it gets better and better, it can displace more types of jobs. I think that some of the recent advancements in AI we've seen can replace some types of, say, repetitive white collar jobs. Especially, give it a few years as it, sorts things out, gets more efficient, more accurate. I do think those are disinflationary kind of anti-labor technologies that take out certain efficiencies in the market, but then hopefully they create other opportunities elsewhere.
uh, just a disclaimer, none of this conversation was automated. I didn't use ChatGPT for any of my questions, so this is a purely human interaction. But this may change in the future. You may be interviewed by a robot. Who knows? But Lyn, I want to close off our conversation about employment on your thoughts about where unemployment will go throughout the course of perhaps this coming recession. How high could this number go, keeping in mind that the last one during COVID was nearly 20%, but that was an anomaly. And which sectors, so two-part question, how high do you think unemployment will go, and which sectors do you think are most at risk?
So I think that's partially going to be a policymaker decision. Depends how much they want to fight inflation versus, keep the economy somewhat on track. So, predicting that is partially predicting what Jerome Powell is going to do, what Congress is going to do, whether they might jump in with fiscal support or not, and what timing around that. So I'll be the first to say that I don't know the answer to that. If we look back at a number of recessions, I think the dot-com recession's instructive here because there were similarities with these types of assets that were very euphoric, right? The tech sector, especially the unprofitable tech sector, that was clearly a bubble both that time and this time. What made that recession interesting is it was actually a very mild recession by most indicators. So that the 2001, 2002, 2003 period was very soft economically, but you had generally less unemployment than recessions that came before it and recessions that came after it. It was one of the more mild ones. So I think it's certainly possible that this could be along those lines, where it's not the gigantic recession that we've been accustomed to in the past, the global financial crisis and the COVID shutdowns. But I mean, there are certainly policymaker choices that could exacerbate it. I mean, if they mismanage how they run the money, because we have a very centrally managed money system, you could certainly cascade into more and more losses. And also, it's also going to depend on how quickly things like AI can ramp up. But generally, I'm looking less at one of those big deflationary collapse type of recessions, and I'm looking more at a stagflationary type of recession. But we'll as data comes in and as policymaker decisions come in, we can get more clarity on maybe how severe this might turn out.
Okay, just on that note about stagflationary recession, what is the level of inflation that you're looking at then? Keeping in mind that the CPI print, at least on paper, has been coming down steadily since last year, and one would have to consider that going into recessions. Every single prior recession going back the last 70 years has seen the inflation rate go down during the course of the recession. So I'm curious as to see how elevated you think this would be in this stagflation.
So I think of right now in the next several months, we've been in a disinflationary cycle. I think we're going to continue to be in a disinflationary cycle. Now in the 70s, for example, you would have inflation come down from a high level to a level that is still pretty high. Yeah, and so recession, I mean, inflation doesn't always go low in recessions. It just always, historically in the US always goes lower. If you look at internationally, if you look at when you see emerging markets have recessions, sometimes they have a massive inflation breakout during recession because their currency works differently, right? Because they have liabilities that they can't print, and they therefore they tend to experience different types of recessions. One thing that makes this period interesting is that, there are tighter energy constraints now. And so you could have environments where Europe and the United States almost experience like an emerging market type of recession. That's more of a stagflationary type of recession where, you know, on the demand side, you are experiencing a degree of disinflation, but it's not as though you're now completely oversupplied with commodities and all those things get super cheap. They could still be somewhat elevated in price while you have ongoing economic contraction, stagnation, things like that. So, again, giving an exact number is partially depending on human policymakers, but the way I would phrase it is that the constraints that are causing inflation to contribute to inflation are still there. And so all the money that was printed is still mostly in the economy, especially now that I think we're getting towards the end of quantitative tightening. That removes some money that was printed, but only a small portion of it. Most of the money that was printed is still out there. We still have not had really a capex cycle in energy or commodities. We've not brought new copper mines online at scale. We've not brought new oil fields online at scale. We're seeing some obviously development around LNG export capacity to, for example, reduce Europe's reliance on, now that they've been severed from Russia, they need more LNG. So obviously there's work being done, but I think the world is still relatively tight on the supply side. And so if you see China really ramp up and fully reopen in terms of international flights and things like that, and if you see, just general more economic activity throughout the world, you could certainly have an environment where oil is back over $100, for example, while you have economic softness. I mean, if you look at 2008, for example, oil was spiking kind of at the early stages of that recession. It was actually in some ways contributing to that recession. And so the timing doesn't always work out the way we expect. So the way I look at it is that if we're willing to go into a recession, we can certainly get inflation down for periods of time. And the question is, when we try to accelerate out of that recession, when we try to have another growth cycle, I think the problem is that inflation, the conditions are still there to reignite another inflation wave. So inflation came in waves in the 70s, it came in waves in the 40s, and I think it's going to come in waves in the 2020s. Even if I wouldn't try to predict the exact lows and the highs, I'm more trying to, look at the conditions and expect the direction.
I had a call from a friend last night, and he's not an economist. He doesn't know much about finance. He's a lawyer, actually, and we had a discussion. He sounded worried. He was like, "Oh, David, I turn on the news, I go on YouTube, and everyone's just talking about this crash here, crash that." I said, "Well, that's probably my fault because I've been interviewing a lot of bearish people." But let me ask Lyn Alden tomorrow. She's very, very smart. Explain in layman terms, Lyn, this coming recession. You said it's not going to be a complete deflationary collapse. To somebody who's not working in finance, explain to him how bad or okay this next downturn could be. And the thing I told him is that, dude, you got to understand, recessions are normal parts of the business cycle. It's just a matter of how severe it could be. So how severe is this going to be? How is this going to impact the everyday person?
So I think that's again going to depend on policymakers. The challenge is so recessions, as you point out, are normal. It's normal for periods of excess to get wiped out. To take out businesses that are not really being productive. That frees people up, frees resources up to go do something more productive, figure out something new, and so that's completely normal. It also wipes out bad debt from the system. The problem is that everything is so over levered now, and more importantly, leverage has gone up to the sovereign level. So what made 2008, for example, such a deep recession is that you had built up private sector debt for decades, and then that rolled over. And a lot of that was then put onto the sovereign level. Basically, we somewhat delever the private sector. We put all onto a lot of it onto the public sector. The problem now is that a lot of it's already on the public sector, and that tends to be a more inflationary scenario because they're still running. If you picture 2008, they were doing these like large rescue practice, like packages that were like, $700 billion. Whereas in the current environment, the deficits are like double that going forward on an annual basis. I mean, it's like the baseline deficit now is like 1.5 trillion. And to the extent that the Fed is eventually forced to resume monetizing it, which you might have partially seen over the past month with, they're still doing quantitative tightening, but now they're actually adding more liquidity into the system than they're taking out. And so if you get back to a period of monetized large fiscal deficits of that scale, in some ways that's like a stimulus. But the problem is that it's an inflationary stimulus. And so on one hand, you have contractions in, I am concerned about commercial real estate. I would not really want to be working in, a fund that like, finances office space, for example. I wouldn't want to be in an unprofitable tech company. There are certain areas that I think are quite vulnerable. But when you zoom out, that's somewhat balanced by the fact that they're just doing these ongoing deficits that are just pouring more money into the economy. And so that's why I think it's a more stagflationary type recession. I think if you work in travel, I think if you work in, if you're a welder, if you're a plumber, I mean, a lot of these people are now making really good salaries because they're still in short supply and they're somewhat recession resistant. So I really think that the severity of the recession is going to depend on the type of work you do, your role in the economy, and what type of assets you own. But in general, I expect it to be a more stagflationary type of recession and one where inflation's ready to return as soon as policymakers are willing to try to get us out of that recession.
Um, S&P 500, is it a continuation of a long-term secular bull run going back to the mid 2000s, or are we going to see what some people are saying could be the start of a new wave of crashes?
So my base case is that the 2020s decade will not be a good one for equities, especially in inflation adjusted terms. Um, it's not necessarily that I'm expecting crashes, although I mean they're certainly possible. It's more like when we're looking back from the late 2020s or we're looking back from 2030, I just think it's not going to be a very good decade. And of course, how volatile it is will partially depend on all sorts of policymaker decisions. But if we zoom out, ever since the 1980s, we've had this period of lower interest rates and higher equity valuations. And because if you're comparing how much you'd pay for an equity to a 10% yielding treasury bond, right? You're not willing to pay much for that equity because you're taking on a lot of risk and volatility, and you can get a 10% yield on the treasury. So you're going to pay a very low multiple for that equity. You're going to get a very high, say, dividend yield, earnings yield, in order to compensate for that risk. But when the treasuries came down all the way to like sub 1%, people were willing to pay almost anything for an equity. Because it's still, has better forward return prospects than a super low yielding treasury. But now that we're kind of in a regime where treasuries and interest rates have really hit the floor, and now they're in this more sideways to up type of environment, that takes out, I think, that tailwind of ever higher equity valuations. And so they're more going to trade in line with their earnings. And so I certainly think you can see a period where, especially in inflation adjusted terms, the major large cap indices just kind of chop around in a band for 5+ years, which is quite common, unfortunately, among global equity markets. The U.S. has been kind of an exception for the past 40 years. We've had among the strongest markets, but I think that trend is probably over, and now we're looking at more. It depends on the stock you're in, depends on the sector you're in, but I think that the big indices are not in great shape. And another factor is that you can look at all these valuation metrics, but one of my favorite ones is to look at household allocation to different types of assets. And when the stock market peaked in late 2021, U.S. households had a record percentage of their assets in equities. And so there really wasn't a lot of marginal capital available to come in. And then when you look globally, countries had basically, both investors in the U.S. and investors outside of the U.S. were kind of like max overweight the US. And so we really have all got on one side of the boat. And so I think now that has some degree of time to unwind. And that's part of my thesis on why we're not going to probably see good equity returns in the US for the next 5+ years.
Your thesis that there's a lower, I guess, risk-adjusted trade-off for going into equities because of higher interest rates, that your assumption is that the end of zero interest rates is here, right? We're never going back to zero?
I think even if we go back to zero, I mean, so my guess would be no, but even if we do, let's say we have a big, massive commercial real estate crash and the Fed cuts rates to zero, the point is we're not going lower and lower. We're not going from 0 to -2% or -3% or -4%, right? We've had not only have had we had a period of low rates, we've had a period of ever lower rates. And so now, even if we just stay at zero or, we bounce between 0 and 5, for the next decade, um, you might have equity valuations remain high, but the point is they're not going ever higher. And so even if you have high equity valuations on earnings, you're still trading in line with earnings. Now, if you get interest rates go steadily upward, then you probably get some degree of earnings, like a valuation contraction on top of earnings. So there's a range there, but really I think the tail of just ever higher valuations is behind us.
Longer term bond yields, 10-year and 30-year, have been coming down. Is that an indication of the health of the economy?
Yeah, the yield curve has historically been a very accurate indicator, especially in the US, less so elsewhere. I think it is showing some of the things you've been talking about, the pretty clear evidence of economic deceleration and borderline recessionary conditions in a number of metrics. And so I think the yield curve is, accurately forecasting problems. And, for a while, the 2-year yield was ahead of, say, the Fed funds rate. But now the 2-year yield has rolled below the Fed funds rate. But, and if you look at also, obviously, like, euro dollar futures and things like that, the market is now pricing in a more dovish Fed than the Fed themselves are indicating. And so I think overall, the bond market, the rates markets are, fully aware of some of these recessionary risks and probabilities ahead of us.
I want to draw the viewer's attention to this very interesting article that you wrote on lynalden.com, which everybody should check out already. I always assume the audience knows you already because you're already so famous, and rightly so because you do fantastic work. But to those who don't know Lyn, she has a excellent website, lynalden.com. Go check it out. And recently you wrote an article called How the Fed Went Broke. I won't read all of it. I'll put the link in the description down below. But one particular paragraph stood out to me, how they became unprofitable. You wrote that in September 2022, the Federal Reserve began operating at a loss. This is because they had raised interest rates unusually quickly throughout the year, including on their own liabilities. Meanwhile, most of their assets are long duration, meaning that their various U.S. Treasuries and mortgage-backed securities are locked in at a lower fixed rate interest rates and don't adjust upwards. This is a very interesting perspective because I've never really thought about the Federal Reserve operating as a business. I mean, makes sense. But can you walk us through, first of all, why you decided to do this research and the ramifications of them becoming unprofitable?
Sure. So I noticed a number of people posting these kind of doom charts about the Fed, and the remittances to the Treasury went deeply negative. And one of the problems is that the St. Louis Fed's charting tool, which people were referring to, was kind of broken for this particular metric. So I wanted to dig into it, make my own charts from the data, and explore what was really going on. And so, I published this article, and when people think of banks, the funny thing is that central banks actually work pretty similarly. They just have a few extremely important differences. So a normal commercial bank, you have assets and liabilities. And in an ideal scenario, the assets are higher yielding than the liabilities, so that the bank is earning a spread, right? So for example, deposits are lower yielding than mortgage loans in most cases. And so the bank is able to make a spread. A central bank works very similarly. So, they one is all physical currency is a direct liability of that country's central bank in the current era. There were periods of time like in free bank, history where banknotes would be issued by a specific commercial bank, but in the modern era, most banknotes are issued by central banks. So, dollars are liabilities of the Fed. Also, banks store their cash at the Fed, and they earn interest on it. So that those are bank reserves. And then there's also reverse repos, which is a little bit more complicated. But the point is they're also a liability of the Fed and they pay interest. So the Fed has these liability sides. And then their asset sides is mainly longer duration assets. So they own treasuries and mortgage-backed securities, and those make up the majority of Fed assets. And for many, many decades, far longer than both of our lifetimes, the Fed's asset side pay a higher average yield than their liability side because banknotes pay zero, bank reserves historically didn't pay much, whereas the Fed's holding of treasuries and more recently mortgage-backed securities, pay a positive yield, and so the Fed operates at a profit, and that's partially what gives it independence. It's not given funding like a government agency like NASA, for example. It has its own funding source, and in fact, it by law it has to give its excess profits to the Treasury. So it's actually been a profit source for the federal government, and many central banks around the world kind of work similarly. And what made this cycle different is that because they raised interest rates so sharply from the zero bound, for the first time in modern history, the Fed's liabilities are higher yielding than their assets. So, what they pay on reserves and what they pay on reverse repos is, they're paying out more interest than they're getting on their very low yielding treasuries and mortgage-backed securities. So they're operating at a loss. They're no longer paying money to the treasury. And I think moreover, it shows what other banks would look like if they were to raise their deposit rates to the level we see in money markets and T-bills. If you were to see banks around the country raise their interest rates to 3, 4, 5%, many of them would have a similar operating loss and start eating into their capital like the Federal Reserve has. The main difference between the Fed and a commercial bank is that nobody can do a direct run on the Federal Reserve. So they're not prone to the same types of things that Silicon Valley Bank was. But the funny thing is the Federal Reserve has about $1 trillion worth of unrealized losses while operating at a loss. So it's actually if it were a bank, it would be bankrupt. But because of just its own operating thing, it's still able to operate, and it just kind of shows the crazy times that we're in.
You did right. It could keep functioning at a loss indefinitely, at least on paper. It's an accounting gimmick. I'm going to spoil the movie for the audience here. You did write your conclusion, a rather anticlimactic conclusion. So you're projecting the tangible equity to turn negative later in 2023, and you wrote, "What happens when the Federal Reserve's tangible equity turns negative later in 2023?" You wrote nothing, at least not immediately. Can you expand on that for us?
Sure, and as an update, since the article is written, now tangible equity actually has turned negative. So the Fed has, there's two ways to measure it. I mean, one is that, even not marking their assets to market, they now have tangible negative equity. But then if you actually mark their unrealized losses to market, they actually have $1 trillion or so in negative equity. And so again, if they were a bank, they'd be bankrupt. But because the Federal Reserve is different, they're able to, kind of record their losses almost like an asset. They're like, okay, we have this many accumulated losses. And in the future, should we ever turn profitable again, instead of paying our excess profits to the Treasury, we get to pay ourselves back first. We get to dig ourselves out of this hole. Like imagine if you were running on a profitable business and instead of facing the consequences, you can say, well, one day I'll be profitable in the future. So I'll just, I'll add that as though I made that profit now. That's kind of what the Fed's doing.
Well, one of the functions of the Federal Reserve, like any central bank, or most central banks rather, is to function as the lender of last resort, which is to say that if a financial institution of relative importance were on the brink of collapse, and its collapse would greatly affect the economy, the Federal Reserve would have to step in and provide liquidity and credit. Is the Federal Reserve in a financial position to provide such liquidity to all the major financial banks if supposed, hypothetically, all the banks, all the big ones at least, were to go bankrupt overnight and had to have money from the Fed?
So in the modern era, the Federal Reserve doesn't hold reserve, it creates reserves. So by
Oh, that's
definition,
convenient.
it's always in a position able to provide reserves. So yeah, it's never in a case where they say we literally don't have money, we can't do it. Now, obviously, there's still a constraint, and the constraint is inflation. And if the Fed is unable to maintain tight monetary policy while you have above target inflation, then they risk getting longer term runaway inflation. And so I actually think that's going to be a recurring issue this decade. I think that's the big theme is that because of how much debt's in the system, they're going to be unable to get to a period of structurally positive real yields. And they're unable to get to a place where they can get their balance sheet down to a normal size. And so I think you're going to see ongoing deficit monetization. Now, there's periods of time where they might not do it, like the past year, for example. They cease deficit monetization. They reverse course for a period of time. So that not every month, every year, they're necessarily doing it. But I think the general trend is that they're essentially stuck. And again, I mean, they always have capability to bail out any individual bank. They can never run out of dollars, but they can devalue the purchasing power of those dollars.
Right, right. I guess they could also devalue the debt, but that's another story. So the Federal Reserve, I noticed that their central bank balance sheet has recently spiked up. What does that do to?
That's due to loans. And so basically they now have facilities. So if the bank runs had continued, right? So a lot of these banks have unrealized losses. They're in a similar position to the Fed where they bought these treasuries and mortgage-backed securities back when they were lower yielding, and now they're much higher yielding, which means their prices are way lower. Now, normally that's not a problem because those are nearly risk-free. When they mature, they can get all their money back, and banks are allowed to hold those to maturity and not have to worry about those losses. Now, the problem is if they have a bank run for any reason, if deposits pull out, maybe they pull out quickly because they're worried about the bank solvency, or maybe they pull out slowly because they want to go get higher yields in money markets or another bank, then that bank has to sell those securities. And so those things that they expected to hold to maturity are now being sold at a loss. And that can destroy the bank, and that can also, make some depositors not get their money back, and it creates like a vicious problem. It also can break those securities markets. If a bunch of banks are selling treasuries at the same time, the treasury market can go illiquid, similar to how it did in, say, September 2022, or even worse in March 2020. You can get these illiquid, volatile treasury markets. And so what the Federal Reserve did is they opened a facility after Silicon Valley Bank failed, and they said, okay, if you have a bank run, then instead of selling your securities, you can use them as collateral at face value to get a loan from the Fed. And so even though on one hand they're still pulling liquidity out by doing quantitative tightening, these loans represent a injection of liquidity back into the system. And so you've had 2 weeks of very large up moves in the Federal Reserve's asset side, and now 1 week of mild contraction. And I think it's probably going to trend sideways for a period of time until there's a more severe issue.
Final question on banks, and I want to touch on your book before I let you go, Lyn. I have this chart that it's been circulating online. It's commercial bank deposits in the U.S. Shown as an annual percentage change, and you'll notice that there was a huge downward spike that kind of started around late or early 2021. February 2021 is when the chart kind of peaked and then turned sideways. I'm looking at the percentage change. And so now it's sitting at negative 4% from a year ago, which means that the net deposits are negative, which means that there's net withdrawals. People have said that this is a response to the banking crisis, but actually, if you look at the chart, like I said, it's been starting since 2021. How can you explain this trend, and is it worrying to you that we're in negative territory right now?
So a lot of that is from quantitative tightening. So the Federal Reserve is letting bonds mature off their balance sheet, and they've been doing that since early 2022. For before then, there was just a slowdown in how much quantitative easing they were doing. By late 2021, and then as they entered 2022, they were outright doing quantitative tightening. And the way that works is that basically, if bonds are leaving their balance sheet, not because they're selling them, but because they're maturing them and then they're not reinvesting them, it means somewhere else in the system, someone has to buy those bonds. And that happens generally with bank deposits. And, when you have QE or QT, and it's mostly buying or selling things to banks, you generally don't get a big difference in broad money, things like deposits. But if non-banks are the ones that are, having to get rid of their deposits and buy those securities, then you actually have a net contraction in the number of total deposits in the system. And so really a lot of that is Fed activity. Now around the margins, you also have money markets and things like that due to the rate differential that the Fed has created. But a lot of the outright contraction you've seen in deposits has been from this kind of year plus of quantitative tightening.
Right. So it's not people taking money out of the banks because they're worried.
Well, I mean, that's so in the past month, that has been a new factor. People weren't really worried before. Once you got those bank runs, you've seen an uptick in money market usage. But I would separate that month from the longer trend that you've referenced.
I guess the next question is, where do people go with that cash if they take the money out of the bank? And that leads us to our next point of discussion, which is your new book that's coming out later in the year. You're writing about the history of money. I believe the book is already edited, but summarize the book for us so we can be prepared and know what to expect.
A big thing I'm focusing on is money through a technologically driven lens. And so, as technology changes over time, it changes what is suitable for money. And so, for example, with the introduction of telecommunication systems in the second half of the 1800s, that gave bank ledgers a big advantage over gold because if you wanted to do any sort of global commerce, being linked into this global system was more attractive compared to, owning physical gold. But of course, the problem was then banks and governments could abuse that. Basically, you had a big difference in terms of transaction speed and settlement speed, and they could arbitrage that difference. And really, the entire banking system as we know it, the modern version of it, has been constructed on this premise that transaction speeds and settlement speeds are different. And both in fiat currencies, we've seen an acceleration of settlement speeds. And so basically with software APIs and social media, bank runs can happen far more quickly, including on a nationwide basis than they could back then. You also have introductions of like FedNow and other services that are speeding up interbank settlement speeds. And then, of course, ever since 2009, we have the introduction of Bitcoin, and followed by things like stable coins and other assets. And these are all new ways for people to transfer value, where the underlying settlement can happen very quickly. And it can go around banks and around central banks. And so my book is basically categorizing the technological trends that have driven us to why our money system's not been working well lately, and then where it might be going in the future.
There's a lot of doomy rhetoric out there about the dangers of CBDC, and I'm not discounting the potential dangers to or the potential threat to your privacy, but I think we need to have a more balanced discussion. Could you maybe summarize some of the pros and cons of CBDCs for us?
Well, the pro side is that people would rather have, in many cases, their government or their central bank be the liability. Because if you have money in a bank, you're trusting that particular institution to remain solvent. Part of the reason people are flocking towards T-bills and money markets is because you have better counterparties. You have the Treasury, or you have the Federal Reserve, providing reverse repos, which is most of what's making up money markets these days. And so there's a lot of interest in having those kind of larger centralized counterparties for people. So that's one reason. Also, in many countries, you have low banking access because it's not profitable for banks to bank them. And so a government could choose to have that be a loss leader and say, well, we're going to be willing to provide basic bank services to everyone, even if it's not profitable on a per customer basis. So those are kind of the pros of it. Obviously, the downsides is that when you centralize everyone's usage of the public ledger, that gives the government extraordinary control. They can surveil everything. They can freeze funds more easily. They can make it more programmable. So they can say, interest rates vary based on your age or based on, other activity. I think countries like China show some of the scarier scenarios for how that can turn out, where they can link like a social credit score, for example, to your money and just basically try to control society at a much finer degree than we've normally been used to. So I think we've had a multi-decade trend towards greater and greater financial surveillance and control, and central bank digital currencies kind of represent the end game scenario for that. So I'm generally not positive on CBDCs, even though I can see why in some cases they're interested in using them. And what I'd rather focus on is building some of these open source alternatives, right? So basically the counter to CBDCs in many cases is things like Bitcoin that say, okay, it doesn't matter what the borders of a country are. It doesn't matter. No one can just like confiscate your Bitcoin if you hold the keys. Now, obviously, those are very early stage technologies, even though they've been around since 2009. It's like the early stages of the internet in the 1980s or the early 1990s. It was kind of used by techies. And so I think there's still work to do. There's still obviously it'd have to be more widely held to be less volatile. But those are kind of the two sides of the coin I think people have in their future. They're either going to get more and more into, kind of centrally administered ledgers, or more and more into distributed systems and away from some of the banking we've been kind of used to over the past 100 years.
Well, I grew up in a household where my parents washed every dime I spent, so this is not going to be any new to me. I'm jesting. Thank you, Lyn Alden, for your excellent discussion and analysis. Where can we find out more about your work?
Sure, I'm at lynalden.com. People can check that out. And I'm also on Twitter at Lyn Alden Contact.
All right, I'll put those links in the description down below, and also the link to the article that I mentioned. And your book is coming out later this year. You don't have an exact release date, but we'll keep tabs on that, and we'll have you back on to discuss that. Thank you, Lyn, again, and thank you for watching. Don't forget to subscribe.